Hi, and welcome back to Money, Markets, and New Age Investing. I'm your host, Greg Weldon, and it is Wednesday after the close of the markets on the kind of a holiday week, the pre-New Year week. It is Wednesday, the 28th of December, and today we're going to kind of take a little bit of a look back and then a big look ahead, all right? What we want to do here is kind of prepare our listeners for what we think is coming next and how to best, deal with the markets and how to best profit from the markets, how to best keep up with the constant debasement of the value of your paper money, which is going to become ever more important. And in that context, looking back at 2022, it's kind of like, did we come out of 2022 better off than we were in 2021 or worse off? Is inflation enough in terms of the negativity to kind of blow away the fact that COVID seems to be gone? Well, the New York Federal Reserve does some excellent research, and one of the surveys that they do looks at households, and it looks at the confidence in households, and it asks specific questions with very specific answers that are then tabulated and put into, a data bank, and that's available, and it's a treasure trove of information in the New York Fed's research department. But in the case of what we're talking about here, let's go back to 2020. The question being, coming out of 2022, headed into 2023, are we better off or worse off than we were a year ago as we headed into 2022? And what does that mean potentially for what we see in 2023? Because it means something. It really does. 2 years ago, the percentage of households that said we are worse off and expect to be worse off in 12 months, we're worse off than we were 12 months ago, and expect to be worse off in 12 months, was 18.3%. The percentage of people saying they were better off, 29%. So 29 versus 18.3. Last year, November, a year later, but a year ago, the percentage of people saying they were worse off and expected to be worse off was 27.9. It had jumped almost 10%. Almost 10% of people in households in America went from basically saying they were better off or the same to worse off. The percentage of people saying they were better off was 26%, so that fell by 3 percentage points. So most of the people that fell into the category of we're worse off and expect to be worse off in the next year came from they were the same. All right? In this November, just released a couple of weeks ago, the percentage of households saying they were worse off had risen to 33.8%, expected to be worse off in 12 months. 34%, up from 18% 2 years ago. The percentage saying they are better off and expect to be better off in 12 months, 24.7. So you've gone from 18% worse off 2 years ago to 34% worse off now. You've gone from 29% of households saying they are better off to 24%, 25%. So people that were, muddling through, that were doing the same over the last, couple of years in through COVID, now are worse off. And it is 1/3, it is actually 0.5, half of 1% higher than 1/3 of the households in the United States say they expect to be worse off. They are worse off than 12 months ago and expect to be even worse off in 12 months. So it's not we're better off coming out of 2022. We are significantly worse off in terms of household sentiment. All right? Now, what's interesting about that is the reason that everyone cites in these surveys is inflation and that it costs more for everything. And it does. And when you are not earning more money, it becomes kind of problematic to pay more for everything. So, of course, you feel worse off financially. When we talk about inflation, all right, the Fed is raising interest rates, talks about inflation all the time, CPI, the Consumer Price Index, the PCE, the Personal Consumption Expenditure Index. Wow, let's use a lot of fancy words to describe the same dang thing, how much it costs for households to buy the necessities they need, and if they have any money left over, how much are discretionary items like furniture and clothing and eating out and concert tickets costing. Everything costs more, from insurance to parking to public transportation to childcare if you're a commuter in a major city. And by the way, okay, they won't tell you this, but the inflation rates in the urban areas, the major cities, the Atlanta, Dallas, San Francisco, New York, Philadelphia, Chicago, all right, Palm Beach, Miami. The inflation rate in cities in America is much higher than the headline rate of the all items, all country inflation rate that you hear on television. So with an inflation rate higher in the places where the most people live, right? So if Wyoming inflation, is 10%, who cares? Because not a lot of people live in Wyoming, and the only people that really care are those living in Wyoming, right? And it's not a knock on Wyoming. Gorgeous place, clearly. Very nice lifestyle, all right? But in terms of the inflation rate affecting consumption at the margin, which is driven by household spending, the inflation rate in New York City, Miami, Dallas, Atlanta, and San Francisco matters much more, and it's higher than the official statistics. So know that, number one. And in terms of the bottom half of the income scale, if you're making below $59,000 or $64,000 a year, depending on whatever median or average, a U.S. household income you want to look at, you are really choking, okay? So when we talk about that, you're talking about 40 years where you had no inflation. Now the Fed's fighting inflation. The problem is there's been inflation over the last 40 years, a lot of it, tons of inflation. Everyone's enjoyed it. They love it. You love inflation when it's asset prices that are inflating, when it's a wealth effect feel-good factor that is being caused by inflation. But this is the script's been flipped. 40 years without inflation, 40 years of ever lower inflation rates, ever lower interest rates, that trend's over for a variety of reasons. Supply chains are just one of those reasons, all right? But you're shifting, and you've seen a shift, you've seen a reversal, and while inflation's going to fall here, maybe not as much as we would have thought 2 months ago, because all of a sudden gasoline and crude oil prices are rising. If they rise enough to wipe out the fact that they are still lower than they were a year ago, you take out that negative impact on the consumer price inflation data, and that's going to be a real problem for the Fed, but we'll talk about that maybe another time. Not quite there yet. That's February, March, April. But where we are is households that have experienced this inflation, and it's a double whammy. Why? Because in the pandemic, again, I've talked about this in the last episode. You take the numbers on savings, and you take the annualized monthly number that people put away. You hit a peak in savings in the U.S. during the pandemic of over $6 trillion. That's a big pool of savings, and everyone talks about it. And people talk about it on TV as if it's still there. It's not. It's gone. It's back below. It's like closer to 1.2 trillion, which means 6 trillion to 1 trillion, all right, in savings. And the degree to which it's below the level it was in 2019 before the pandemic. Number two, credit. You've had record borrowing by households, record lending by commercial banks too. But, consumer credit, the Fed's version of it, has been on a tear that is unprecedented to the likes and to the degree, that's the point, the degree to which its records is massive. Massive borrowing being done. You have increased wages, but the real wage growth, compared to the prices you pay more for everything compared to inflation, is the deepest negative number we've seen in years. Wages are deflating. Savings are gone. People have borrowed to the max. The next hit in the recession, layoffs that are coming, is really going to be felt even more. And if inflation comes down and it goes back up, which to me seems likely, and I'll explain why in a minute, that's a real problem for the Fed, because what you have coming is a recession. We've talked about this. Every time that we've had a triple play, a hat trick, I'm a big hockey fan, New York Rangers, go Rangers, let's go Rangers. Every time you score a hat trick, meaning three things specifically: yield curve inverted, dollar up 20% or more year over year, and the food at home price inflation above 6%. We just had all those things at the same time. Every time that's happened in the past, all three of those things occur simultaneously. It's been a recession 100% of the time, the next 12 to 18 months. And again, like I said before, that means it's been red 30 times, doesn't mean it can't come up black, and it doesn't mean it can't come up red. Anything can still happen. But that's an interesting fact that has a cause and effect linked to it, all right? In a recession, all right, given credit, and credit's harder to come by all of a sudden because interest rates are up and banks are holding back and mortgage rates are through the roof. We'll talk about housing in a second. What you have is, and it's already starting, albeit from really low levels, because you had so much forbearance. You don't have to pay your rent. You don't have to pay your student loans. You don't know, we'll give you food. And that's all well and good, and that's part of what the government's there for. But at the end of the day, that's what they call transfer payments, are still running over $3 trillion annualized. And still, all right, when that starts to slow, and it will, because the government's not going to be able to afford to keep that up, not without seeing even higher interest rates and higher inflation. It's a balancing act, and we can talk about that in a second too. But the bottom line here, when we talk about what's coming next in terms of the economy, it's rising delinquencies, already see it, particularly in the auto loan sector, by the way. We'll talk about that another time. in bankruptcies, failures, closures. I mean, we're seeing restaurants here in Palm Beach, and this is everywhere. And I talked about this to my institutional clients a year and a half ago. You've had all this forbearance and companies, and particularly restaurants and bars that have really struggled, but have managed to maintain somehow by adapting, by going outdoors, by doing delivery. We've heard some amazing stories, even in the Northeast about, diners all of a sudden delivering breakfast, as a way to maintain and survive. But, it runs out in terms of when margins are so razor thin and rents are higher now and employees are hard to keep and they cost more. Holy mackerel. The wave of closures and failures of those types of businesses is only just hitting. We're already seeing layoffs. The Fed talks about wanting to see the labor market cool off. It's a problem because it's not going to cool off because so many people have dropped out. Say everyone's dropped out, but so many people have dropped out. We're talking millions of people no longer in the labor force, not counted in the unemployment rate, and expected to come back in and fill those jobs, but they're not. So there's a lot of jobs available, but the degree to which companies now, because of a variety of things, number one, cost increases, are laying people off. And at the very least, we've seen this in the Fed surveys, hiring freezes have become a much more common thing across America. So that's a big signal when layoffs are rising and job freezes are becoming more popular. Isn't that a sign, Mr. Powell, Mr. Chairman, Mr. Fed Chair, that you see some slack developing in the labor market? So in that point, again, we talk about the inflation in prices, and this is why the Fed is hiking rates. But in so doing, they've lifted the dollar to a point where it hurts asset prices. The inflation here is consumer prices and things you buy. We haven't had that for 40 years. But 40 years, we've had asset price inflation, funneled, stimulated, facilitated, the catalyst for which has been, the printing press running 24/7 and printing, trillions of dollars a year. Now that's ending. What do you think that's going to mean, too? But the bottom line here is the price increases for households and consumers and all the things you have to buy just to exist, the necessities, all right? And you see the deflation, which used to be in those things, now in asset prices, okay? Let's kind of talk about asset price deflation in housing, in crypto, in the memes, in info technology stocks. They're down huge. They're down like 40% year over year. All right. Talking about the semiconductors, talking about, anything that's linked to electronics, talking about the consumer discretionary stocks. They're getting wasted, man. Bonds have cratered. All right. Currencies have cratered. You have asset price deflation that is pretty rampant, frankly, and it's only just started in the degree to which you could say, look, the info technology space is down 35%. The technical work that I do and the recession that's yet to even hit, you could easily go down another 35% from here and not really even blink in terms of it being extreme in the technical analysis world. So, the bottom line for the Fed is they're kind of trying to let some air out of a 40-year bubble without the bubble bursting. And that's a tricky thing that has rarely been pulled off. The Fed has a balancing act of unprecedented proportions, all right? And they talk about this all the time. The most recent meeting was, we fear a bigger mistake is easing, okay, or taking our foot off the brake in terms of tightening too soon, too early, before inflation is eradicated. In the context of, is the Fed too tight? Are they too tight for too long? Are they too high already? Are they going to go too high? Or are they not high enough? And can they become, not tight enough too quickly if they flip here? All right. It's almost like reminds me of the Goldilocks and the Three Bears. Is the porridge too hot? Is the porridge too cold? They're looking for the recipe that gives you the correct monetary porridge temperature, and that's difficult. A way that I like to look at it is Nick Wallenda. You're talking about a balancing act, all right, trying to walk across Niagara Falls with the bouncing bar. And it's if you tip too far one way, you're going to get hyperinflation that's going to crush the economy. If you tip too far the other way, and that would be, easiness in policy. If you tip too far in terms of tightening, you have a recession, which could lead to a debt deflation. So, it's kind of like, which one's it going to be? All right. We're in the age of the polarization, of course. So, the spectrum is so widely pulled apart. You really have kind of, again, it's like, tip too far just by a little bit, you fall into the ravine and into, what was it? It was like something like 600 feet into the water. Basically kill yourself. All right. But in the age of polarization, it's not one or the other. It's more of both. And that's exactly what we have. That's exactly what we're going to get. Let's talk stagflation. All right. Stagnation in the economy with continued inflation. I mean, wouldn't that be interesting? All right. The risks here heading into 2025 are significant in terms of the types of things that could come out of a recession, financial stress and risk. And they want to tell you that everything is cool in terms of the financial system since 2008. That's not true. It's just not true. The degree to which derivatives held by banks have been cut, thank God they did that. Thank God they got more severe about that, because the biggest 88 or 89%, I forget the exact number, but it's just below 90% of all derivatives, which the last time I checked was still like $200 to $210 trillion globally. All right, lower than it was at the peak in 2007 when it was $250 trillion. But in the context of that, the bulk of them are for trading purposes, not even hedging, because derivatives were built by banks to hedge their bond exposure, right? To hedge a move in higher interest rates, for example, and how that might hurt their holdings or hurt their business or whatever. But the derivatives now, the bulk of them by far are held for trading purposes. In other words, to make money, for profits for the banks. I mean, it's in times when, like now, when there's not a lot of, other types of business, particularly in housing and mortgages, is shut down and so on and so forth, where trading operations for some of the big banks, particularly the used to be, trading houses like Goldman and JP Morgan and Morgan Stanley that are now banks, this is where they make a lot of their money. And it's a big part of the reason, they were really successful 2 years ago. But when we talk about the risks that extend from that, I mean, they're significant because you still have all this debt that is linked to to fixed income. So in other words, all of these derivatives were betting that interest rates would stay lower. And that's a problem if, you don't see some come down. Some banks took protection. I mean, it's not a problem right now, because I think there was a general perception that the Fed is going to get to a level here very closely, and then, that's it. It's not like they're going to continue to chase inflation higher, because everyone believes inflation will come down. I do too, but I think that's temporary, and I don't think that's the way other people look at it. All right. But within that context, with higher interest rates come a whole bunch of problems. Pension funds, underfunded pension funds. Everyone knows about it. People talk about it. You go to a conference, someone's going to talk about it. Someone's going to show you the charts. Chicago, particularly as a city. Illinois as a state. You can list the states. California, has improved somewhat, but still really underfunded in terms of pensions. Massachusetts, New Mexico. I can start to list the states. Indiana, Illinois, New Jersey, New York. In the context of Chicago, which has made vast improvements under the new mayor there, all right, a big decline in revenue now is really hurting them. And they're one of the lowest funded pensions out there. You're talking about 30% of their obligations are covered. What are you going to do? You're going to start laying off cops in a city where they're shooting each other? Where crime is, pretty high still? I mean, that's what happened in 2008 in Camden, New Jersey. Because of fiscal problems, because of a lack of revenue, they had to lay off 40% of the police force in the city. Camden, for a mid-sized city, was the second highest in the country in crime. Think about the deflation in the standard of living in ways that are not necessarily right in front of you or tangible in your consciousness, but are right in front of you. All right. The other thing would be, in terms of the government's budgets and government debt and a sovereign debt crisis. All right. When you talk about even that, you're talking about the liquidity in bond markets is becoming more problematic. We've seen episodes already in Japan and the UK where the liquidity is not there. All right. You talk about having to refund all this debt at higher yields. All right. I think I mentioned last time, the UK, 12% of the current budget revenue goes to paying higher interest rate costs to refinance the debt every month, every quarter, every year. 12% of revenue to pay the increase in debt costs, in debt servicing costs. That's insane, man. And that's why you almost had a total implosion in the UK bond market. There's going to be more of this. The liquidity in bond markets is a problem. In foreign exchange, the BIS, Bank for International Settlements, just did a great study on the risk heading into this in financial assets and these kinds of things. And one of the things they cited was, first of all, a huge increase in foreign exchange trading. And number two, the huge increase, a lot of it coming in off-market transactions. So they basically are risking, they're saying one of the bigger risks is missing dollar debt that's not accounted for anymore. That could blow up at any time. You don't know who holds it. You don't know who it's owed to. I mean, just in terms of trying to figure out, where the dominoes may be, you don't see the dominoes until they fall. You're talking also about mortgage-backed security market where the liquidity is dried up. All right, and if banks are not going to be buying them and the government's not going to be buying them, who's going to buy them? Who's going to be the backstop to provide the cash for all these mortgage bonds that are created with all the new mortgages? Well, right now, there's no mortgages being created because the housing market's collapsed. The mortgage market has collapsed. Sales have collapsed. Inventory's starting to rise. You're still going to have a problem. Prices will still be higher down the road when people can less afford it. So again, it's a problem longer term. You have international debt, which is somewhere around $120 trillion. All right. And when you're talking about the government debt, I mean, it's just huge. $120 billion, which is international debt, which is dollar debt that was issued by other countries. All right. Central banks can lose control of the bond markets here. In that case, you have yield curves that really steepen because, inflation maybe get loose. Consumer debt's a big problem. And we're not even talking about the potential for other things to resurface as issues, i.e. supply chains and China and COVID even. If you get a new variant out of this huge explosion of COVID cases you have in China where people are not dying, or at least they're not telling us they're dying, you could have a new variant. This is why the U.S. is already thinking about, oh my God, here we are heading to 2023, and what are we hearing? Border closures, not allowing people from China into the country because of COVID. Are you kidding me? Holy mackerel. What's coming next? It's a recession. They might want to lock people down, so COVID's a good way to do that. I don't know. I don't get into that kind of thing in terms of trying to figure it out, but I have my own personal thoughts on it. And what I do believe is that, China's playing games here and always has been. You have the risk of China in terms of shutdowns and how that affects the supply chain. China would love to crush the U.S. economy to some degree. It's kind of mutually assured destruction, mad, as it were, economically. But, the U.S. has kind of launched the nuclear financial weapons in terms of Russia, seizing central bank assets. And then Russia played back with natural gas. We know where China is in terms of the currency. They could drop the currency nuke at any time. We don't have the best financial nuclear weapons here. China and Russia do. And although they are still at a major economic disadvantage, it's a lot of it comes down to the currency and the risk and the whole dynamic here around, how does that play out over the longer term? And, when is that bomb drop? And we don't know, let alone Taiwan. All right. And do we not think, by the way, and I've been doing this for 4 decades, and I'm telling you, U.S. holidays, particularly over weekends, and particularly Thanksgiving is always that Friday and Thanksgiving, and just this past weekend of Christmas, when you have very illiquid markets. On Monday, Japan, Korea, and China were 3 of the only countries that had open markets. Do we think it's coincidence that the Chinese renminbi was pegged by the government at a higher level in a major reversal on Christmas when no one in the U.S. was even around really paying attention? I've seen this happen so many times where you wake up after a holiday like this and you have a big new trend started and it came out of nowhere and you got to react. All right. In that context, of course, trade with the U.S. is a big deal, and that is a big problem going forward. But it's a big opportunity. Because the question is, in 2023, with all this risk, with stock markets that could go down big time again, supply chains that could cause inflation to rear its ugly head again, let alone the central banks could lose control of bond markets and the yields skyrocket here, making credit more difficult to get a hold of. It's kind of scary. It's a bit of a storm, but there's opportunity that's created by this too. Again, it's not just survive. It's still try to want to thrive. And you want to stay ahead of the pace at which they devalue and debase the purchasing power of your paper money, wealth, and income. So what do? Well, buy and hold to me is dead. It just is, because that's kind of where the next shoe's dropping here in terms of some of the stocks that are getting whacked in the consumer discretionary sector in particular. Stock like Amazon that everyone owns. Do you do passive investing? Do you do index investing? Do you peg your thing to the stock market? Well, maybe the stock market will be higher in 10 years. And again, all of these questions I can't answer. You can answer. You answer it by understanding what your goals are. Is it long term? Is it 10 years? And we'll get into that more in just a minute. Because bottom line for me is now I hear a lot of talk about averaging down. Big mistake. I don't like averaging down. I don't like adding to a losing position. And I just think that in this case, of all the times where that has worked, I don't know that the probabilities of that working again here are even close to as high as they have been in the past. I don't. And I think it's a very dangerous game, especially when you hear everyone wanting to do it. It's hope, greed, and fear, and that is hope. Hope that may not be fulfilled. All right. To me, you could have a case where stocks go down, get a bounce, and then go sideways for the next 3 years. That's not going to help you keep pace with the depreciation of your money. You'll be left behind. So let's talk about ways, and already from what I've talked about to some degree, I'm a proponent of trading other things. We're going to talk about the stock market specifically because most people want to know about the stock market, and certainly we do that too. But we'll talk about that in just a second because this is more about other things. And the FX market, foreign exchange currencies, is a good example. You just had, because the dollar was so high, because the Fed was raising interest rates so aggressively, one of the biggest increases on a year-over-year basis in the dollar that we've seen in the last 40 years. Of course, there's something on the other side of that, and that is the 29 currencies globally that were either at, near, or just about to make new all-time lows or breaking down on a secular 10, 15 to 30-year trend basis. 29 of them at one point, just recently, at new lows. I mean, so these currencies have been getting whacked, and I've talked about this last time too, in the context of these are places now where the appreciation in dollar commodities, namely food and energy, is exacerbated by the currency depreciation in these countries. U.S. inflation has been held down by the fact the dollar's so high. It would have been higher like it is in Europe. The euro got killed. Where's European inflation? 9, 10, 11, 18% in some places. So that's the currency impact. The FX market, again, another study I just read recently was a 90-pager on some of the differences in markets from 10 years ago. It's a triennial. It's from 3 years ago. Right now, the FX market trades $7.5 trillion a day. That is multiples of GDP globally per day. Multiples. And I forget the number, but it's a big number. A big number. $7.5 trillion a day. That's larger than the Fed's balance sheet trades every single day in foreign exchange. All right. In that context, 90% of it is in dollars. All right. 6.6 trillion a day in dollars, kind of linked to trade. All right. And that's up 14% from 2019. 14% increase in dollar turnover, most of it linked to trade. All right. But in the context of the US, only accounts for 10% of actual global trade. 90% of trade in dollars, but the U.S. only facilitates 10% of global trade. That divergence has never been larger, and it's insane, and it doesn't make sense for China. Now, Chinese percentage of FX turnover daily has gone from 1% 10 years ago to 7%. Lower than you might have thought, right? The euro has gone down from 39 to 31. The yen is stagnant around 30. So, to whatever extent we're talking about turnover relative to overall turnover as opposed to relative to trade. So in that context, we have 90% of turnover in dollar terms, where we have GDP, U.S. accounts for less than 25%. All right, the amount of dollars held in foreign exchange reserves by foreign central banks has dropped from 72.5% in 2000 to 58%. Why? Because they're buying gold and renminbi, and lesser extent euro, really, not so much. More renminbi, it's more gold. So that's kind of interesting too. So I think, to me, foreign exchange is a place you want to trade. And in that context, there are plenty of ways, even in the stock market these days, to trade these other markets. I prefer the futures markets. And we will talk much more about this in future episodes. We're going to talk about the contract sizes. We're going to talk about the new mini contracts they have, the micro contracts they have, and how you need to be funded, and how most futures traders are not properly capitalized, and it's almost a 100% risk of ruin. I'm going to show you the math that will help you if that's what you want to do. In the meantime, more people trade stocks. More people ask me, what stock do I buy? How do I play the commodities and currencies and stocks? And you can. All right. The FXF is the ETF that tracks the Swiss franc. Okay. So to me, I'm long the FXF because I'm bearish on the dollar. I think the Swiss franc as a currency is going to go higher. All right. Also, currencies that are involved in commodities, like the New Zealand, Australian, and Canadian dollars, would be preferential. I don't own them right now, but looking to own them at some point in the future. All right. So playing off against the dollar actual depreciation, which then exacerbates the depreciation of the value of your money right off the bat. All right. But it's also in commodities. All right. Where something like the SOYB is the soybean ETF, trades as a stock, tracks the price of soybeans. Soybeans to me are a big positive commodity. Coffee is another one. Bought coffee today for our money management clients. All right. The ETF where you can buy coffee in the stock market is JO, like a cup of Joe. All right. The another one I like is sugar. All right. Cane, CANE, is the ETF for that. Cotton, BAL. Cocoa, NIB. You can see where I'm going. Agricultural commodities right now and metals. All right. We already talked about the SLV, the silver, and that just recently made new highs. It got whacked a little bit today because the dollar was higher, but I think the trend is still higher. Platinum is breaking out, silver's breaking out, copper's breaking out, gold's breaking out. And the big change here today, and I talked about this last time, was the lack of confirmation coming from the mining shares. That's changing too. The silver mining share ETF, the SIL, broke out this week. The GDX in gold is on the verge. The GDXJ, which is the junior gold mining ETF, is breaking out against the broader GDX. That's a positive for the entire sector. The fact that silver is outperforming gold is a positive for the entire sector. So there's a lot you can do. I'd add energy too. UGA is the gasoline ETF. So there's a lot of ways you can play this. In terms of the actual stock market, I mean, right now where we're at, I also do algorithmic stuff. We create portfolios. We do a lot here, and besides the podcast, for institutional clients and for licensees for big managements and investment trusts and hedge funds and pension funds and even some foreign governments. When talking about meaning sovereign wealth funds, I should say in that context. Right now, where you're at, all right, what we do is we track the bullish and bearish stocks in all these markets. In the S&P 500. Particularly, break down how many of the S&P 500 are in bullish trends, how many are in bearish trends, how many are not in any trend. I have a trend identification algorithm I wrote in the 1980s and have applied and used and deployed my entire career. And I'm telling you, they're robust. They work. And I know I have total confidence in them. And this is a whole part of the psychology of trading is you have to have confidence in your methodology because guess what? It's not a straight up game. You have drawdowns. And if you can't stick with your discipline when you're in a drawdown, that's going to be a problem. Right, I have full belief that I know my drawdowns. I know my weaknesses. I know where we tend to have drawdowns. So I can deal with that because I have really studied my own tendencies and my own trading history and made the tweaks I need to make. Something you got to do. You're going to learn. You're going to make mistakes. But in the context of where we are right now, all right, consumer discretionary has the biggest negative skew next to information technology and real estate. Over 30% of the stocks in those sectors are in bearish trends already. All right. The XLY, which is the consumer discretionary ETF, is down something like, I think it's 36% over the last 52 weeks and just made new lows this week. Not only that, it's falling relative to the S&P 500, which is always a leading indicator, and it's falling relative to the XLP, which is the consumer staples. So in other words, if you are not doing well in terms of the people that sell sporting goods, furniture, clothes, eating out, online shopping are doing poorly, because people have to buy personal care items, food, pharmaceuticals, drugs. I mean, the things they have to buy, shelter, insurance, all these other things. That's a negative for the economy. And that's a negative for the stock market because the discretionary is the margin of consumer spending that drives profits and growth. Without that, the stock market's in trouble. So when discretionary sector suffers relative to necessities, that's a big tell in terms of where the economy and the market are going. And right now it is very negative, really negative, suggesting another big decline potentially in the stock market. The thing that's the most positive, those exact same things, consumer staples, the necessities, things like, Procter & Gamble and the place where you buy toothpaste and the food and all these kinds of things that you have to buy and you can't really skimp on in terms of maybe you buy a lesser brand, maybe you don't use as much toothpaste or as many garbage bags or whatever. All right, you can't not buy some of these things. So that's a tell. And right now, that tell is kind of negative. Overall, and what's interesting about that is the polarization that we have and the fact that consumer discretionary is one of the weakest of the weakest three out of all of them, and consumer staples is the strongest. That polarization right there is telling. So how do you go about kind of deploying all these things? We're going to talk much more about portfolio allocations, position sizing, all these kinds of things will be coming. Can only fit in so much. Wanted to get this in before the end of the year so we can come out next year and talk more specifically about some of the trading techniques that we can deploy. But I can tell you in terms of the trading side, in terms of kind of the boot camp nature of what we want to do here to some level. What you really need is a methodology. And even though the methodology and the discipline is only 10% of what makes you successful, okay, risk management and psychology is the other 90. Getting the methodology is the first thing you got to do. And it fits in with your psychology or it doesn't, or so on and so forth. All right. It has to, whatever your methodology is, has to fit you. Are you a day trader? Are you a long-term trader? Do you have the time to do the work you need to do this yourself, first of all? And if you don't, then you're better off finding someone that could do it for you. I think people that, run CTAs and, that do things outside the box like we do here are going to become more valuable over time. So, there's a lot of good people out there, a lot of good hedge funds, a lot of good CTAs. So you can, give up control of that to someone that you feel, understands what it's going to take to protect your money and to grow your money. But if you're doing it yourself, which frankly, I kind of recommend, find researchers like me and other people. There's a lot of good people. I certainly can always give recommendations. Maybe we'll have to put out a list of recommended research providers, because there's a lot of good ones that I respect that I think, that, if you want to learn more, you can follow them as well as follow me. But the big picture view, do you believe that the stock market is going to go up forever and that you have to buy stocks? Well, you have to have a methodology that fits that. If you believe that, it's the opposite, then you need a methodology that allows you to take advantage of that or whatever system, okay? And whatever time frame you have based on your goals, based on your age, based on your financial situation. That's all personal. I can't give you all of that, okay? But the problem here, again, is can you trade against your belief? So say you believe the stock market is going to go up forever. Do you always trade with that belief, or do you have the potential to see things outside the box, to have an open mind to say, hey, maybe this isn't the time to be passively buying stocks and averaging down? Can you actually trade against that bigger picture belief that you have in your head? Even more important is your discipline and what they call R multiples. All right, R multiples is basically the differential between your average profit and your average loss. Okay, and that gets back to your initial trade risk. And so, it's different markets, different types, different performance. I mean, can you trade in a bull market? Can you trade in a bear market? Can you trade foreign exchange? Can you trade just stocks? And again, do you have the time to do the work necessary? These are all things you have to consider and make happen, right? And if you're unsuccessful, if you go into a bad streak and you have a run of bad trades, you have a bad thought process, your system's not working, or, you're getting psychological, you need to make money and you're not making it. When you need to make money from trading, guess what? You're never going to make it. That was the worst possible scenario. That's the psychology you can't have. I need to make money to pay the bills. It's not going to work. Your psychology will circumvent it every time. The question is, do you change your system? Do you change your criteria or beliefs? What do you change? And what are the setups you want to see to get in a position? Okay, does it have the right R multiples? In other words, the right risk reward. These are all things you have to consider. All right. And what's interesting too is some of the studies that were done, in the past about trading methodologies and system building. It always fascinate me. But entry levels are the least important thing. You want to own something, just buy it. It's not important where you enter it. It's much more important where the risk is and how much you buy. And we're going to talk more specifics about these and give you some tips on ways you can use volatility to help you put in risk fail-safe methodologies and stuff like that. And I do also want to say that I'm going to throw up some charts on some of the things I've been talking about today specifically, and really housing is really interesting to me. We'll talk about that too. But if you want to see some cool charts that I might post from time to time, not promising anything. The podcast is, different than our regular business. But I do want to kind of give you visuals on some of the things I talk about. You want to see that, follow us on Twitter. And that is at money_podcast. That's simple. We're the Money Podcast with the underscore in the middle. All right. If Instagram, where it posts, little trading wisdoms and insights and kind of, a little more about trading as a boot camp type of thing, is on Instagram. All right. Where it is age_of_polarization_investing. And we'll have some posts on that. In the meantime, have a great New Year's weekend. We'll be back at it next year. And we're going to cover all of this and more in depth on money, markets, new age investing. I'm Greg Weldon. Thanks for listening.